Morning. Good morning. Before we start, just two reminders. There is a company, Tilly Baker, is looking for intern in case you are still looking for a place. But I think the deadline is tomorrow, and the initial application is not like they only ask a cover letter and something really short. Secondly, there's an assignment out there. Assignment 2 has been posted and it's due this weekend. Okay, so today our plan is first we'll do a comprehensive earnings per share example. That's first. And then we will, as I said, for each chapter, I pick a theme to review. So we'll review for chapter 18. Income taxes, and the review topic is assets liability approach versus revenue expense approach. Okay, so go ahead with the comprehensive example. Okay, so this one is posted. Oh yeah. Okay, this one is posted. So basically, like earnings per share, for basic earnings per share, there are two problems to solve. One is the numerator to determine the earnings belong to common shareholders. For the denominator, that's the weighted average number of shares outstanding. We need to consider the new issuance, the repurchase, and the stock split or large stock dividends. For diluted earnings per share, when there is a complex capital structure, we need to analyze potentially diluted securities. Two types of potentially diluted securities, convertibles and the options and warrants. So for convertibles, we use if converted method. And for options and warrants, the only type we look at is the call option that's sold by the company. So we will use treasury method. And we need to be concerned about potential anti-dilutive situations. So that's pretty much the old situation we need to deal with. So the first part of this is about the denominator. So we need to just compute weighted average shares of outstanding. And so this company has a new issuance during the period, have purchased its own common shares, and have stock split. So all three situations, right? So, okay. So, I just use this table, like the same one you can use for assignments that lay out all the information. So at the beginning of the year, that is from January 1st, that start out, no change until February 1st. So we'll go January 1st to January 31st. So that's only 1 month. Okay, the number of shares outstanding is 570,000 shares. And we'll worry, I keep this column restatement here, but we'll worry about it when we come to that. So at this point, it's one of the 12 months. Okay, so that's how long, that's the level of shares that was at. And then on February 1st, there is a issuance of 180,000 shares. So that will bring the number of shares outstanding up to 750,000 shares. Okay, and stay that way until March 1st. So that's like a 1 month as well. So it's a set February 1st to February, let's say 28th. Yeah, we have better chance to be right there. It doesn't matter, it's just 1 month, right? So that's only also 1 month. And then what happened on March 1st? Repurchased 250 shares. Okay, so the shares will reduce to 500,000 shares. And then stay like that until June 1st. So that's March, April, May, 3 months. So it's March 1st to May 31st. 31st. How did you guys count that? When we learned that, we use that January 31, and then go like that.
Oh, fuck.
Yes, so that's fine. So that's 3 months. 3 months, 3 out of 12 months, that's what it is. And then we have a stock split on June 1st, and that will double the shares. So number of shares outstanding now will be 1 million. Okay, and that's until September 1st, so June, July, August. So that's also 3 months. June 1st to August 31st. Okay, and that's also 3 months. However, once the split is done, we have to go back to the previous month to make adjustment. So this will have to be converted to the new shares. All of that has to be restated by a multiple of 2. Okay, and then okay, from September 1st issued additional 200,000 new shares. So from September 1st to December 31st, there's nothing happened after that. The number of shares outstanding is 1,200,000 shares, and that is 4 months. Okay, so we compute for each period weighted shares for January is 950. For February, that's 125,000. And then for the next 3 months, that's 250,000 shares and 250,000 shares again, and 400,000 shares. So the weighted average number of shares outstanding would be this. So this would be, let's call it weighted average common shares outstanding during the year. Outstanding through the year. That's what it is. For through the year is 1,120,000. So for basic earning per share, this will be the denominator. So we covered all situations. Yes.
How did you get the restatement figure?
We restatement figure, which part, like this?
Yeah.
Okay. So that's the 2-for-1 split. So it doesn't have to be 2, or we use 2 because it's 2-for-1 split. Yeah. The stock split is the only thing we do retroactively adjustment. Nothing else we need to do that, because a split kind of change the unit of counting, right? The old new, oh, the before split shares and after split shares are not equivalent. They're not same thing. Okay. All right. So we had the denominator. Now we look at the numerator. So we have 4 different situations for us to consider, right? In addition to the aforementioned common shares, Dingo also have $1 million of $5, $100 par preferred shares outstanding for the entire year. And the for this year, the net income is $5,250,000. So about the description of preferred shares. So it is a bit of a, can be messy, depend on if you look at the Canadian company reporting under IFRS, often Canadian company, this is less to do with accounting, but more the security regulation, is Canadian shares tend not to have par value now. You may see par value, but more likely it was issued before the change. So it's like a remnant from the past, right? So if you look at the Canadian company, they give you $1, that's dividends. That's not par value, and that's not issue price, okay? Sometimes they give you extra information, sometimes they're parsimonious, they just tell you minimum what you need to know, what they have to tell. So they have to tell you the dividend. So if it's $1, it's like, say if it's just $5, that's dividend. I think that's the way that information is given in the assignment. So it's a dividend. If you have US financial statement, they have par value, and then their dividends is often given in a percentage. So applied the percentage to the par value, that's how you determine the amount of dividend. So obviously without par value, percentage is not very, it doesn't work, right? So just be aware of this situation. Not only in US, not only they give you par value on the balance sheet, right? Like the common shares, preferred shares, they're into 2 different accounts. So one item is a common share par value, but we all know that stocks often are issued way more for the par value, right? So the difference, they go to the second line item called the additional paid-in capital. Okay, so so that's why. So if you want to know on average how much each share were issued for, you add 2 together, divided by the number of shares issued and outstanding. So that's how you do it. Now, there's no such thing in Canada because everything, there's no par value. So all proceeds from issued shares will go into one line item. So you just, that's that. Okay, so we have that. And then we have these 4 different situations, just because sometimes preferred shares can be cumulative, sometimes it can be non-cumulative. We deal with those situations. And also sometimes company can issue dividends as it's prescribed. Sometimes they skip preferred dividends, skip dividends altogether, and then they will become, do you have dividends in arrears or not? And sometimes if you have dividend in arrears, they will go back to pay previous year's dividends. So like all the situation we'll put here. So the first, assume preferred share are non-cumulative, and the Dingo declared and paid preferred dividends as well as 50 cents per share common dividends. Okay, now, yes, calculate basic earning per share, use the weighted average number of shares determined before. The second situation is preferred shares are non-cumulative, but there's no dividends paid. Okay. The third situation is preferred shares cumulative and have 2 years dividends in arrears, and Dingo declared and paid both the current preferred dividends and dividends in arrears as well as common dividend. The fourth situation is preferred shares are cumulative and have 2 years dividends in arrears, but Dingo did not declare and pay any dividends. So hopefully they covered all the situations, right? Now, so so let's look at dividends first, just like a mini review. Like if we first we'll figured out how much dividend Dingo would actually have to pay to each class. And then we will, based on what we calculated there, and to determine how much dividends should be adjusted from net income to determine earnings earnings belong to common for the computation of basic earning per share. Okay, so in the first situation, Dingo, let me do this so I can see it a little bit clearer. Dingo preferred shares are non-cumulative and Dingo declared and paid dividend. So let's say how much dividend, if they're going to pay, what is the annual dividend for preferred shares? Preferred dividends is a bit similar to interest. There is an annual dividend like a prescribed, but unlike interest, if it's preferred dividend, the company have an option not to pay. But interest you have to pay. If you don't, there are legal consequences, they can force it. Okay, so here 5. So let's do the computation here. Let's do insert a little window here. Let's say preferred dividends per year based on this, the information, right? So we know the dividend is $5 per share. Oh, no, here. $5 per share. Why it insists on? Oh, okay, I got it. Because I'm working on that. So they insist on showing that page. Okay, it's $5 per share. How many shares are outstanding? We were not told, but we were given the information that I could figure it out. So in the account, the preferred dividend had a balance of $1 million. That's from issuing the preferred shares at $100 per share. So that means 10,000 preferred shares were out there. And then so the preferred dividend must be 50,000. Okay, so that's 50,000. So that's 50,000 preferred dividend per year. What it means is if it's doesn't matter it's cumulative or non-cumulative, in order for Dingo to pay common shares, they have to pay the preferred shares first. That's all it means. Okay, so in first situation, a paid preferred dividends, since it's a non-cumulative, we don't even worry about whether there is dividend in arrears or not, right? So 50,000 would have to go to preferred dividend and the common dividend. Okay, so we computed a weighted average shares outstanding. Okay, but for dividends, you do not use weighted average shares outstanding. What do you use? Yes, you use, if the dividends is issued at the end of the year, you use the number of shares outstanding at the time. There's a date of record, remember? Date of declaration, date of record, and date of distribution, right? So on the record date. So we assume it's at the end of the year. So that will be what they have like at the end of the year is $1,200,000. Okay, so that's 50 cents per share. And so it's 1 million, so it was like $600,000. Yeah, so it'll be 600,000 common dividends, right? And the next, that's situation B. Situation A. Situation B, assume preferred shares are non-cumulative and Dingo did not declare or pay any dividends. So that's easy. So no dividends for either group of shareholders. And then assume Dingo preferred shares are cumulative and have 2-year dividends in arrears, and the Dingo declared and paid both current and preferred dividend and deferred, no, current and dividends in arrears, as well as 50 cents for the common. So the preferred share will get 2 years dividend in arrears plus current, so that's a 3 annual dividends. Yes, so the 150,000, and the common will get it's 600,000. The last situation, the preferred shares are cumulative and there are 2-year dividends in arrears, and Dingo did not declare and pay any dividend. So, but this situation number item D and in item B differ in a sense that now there are 3 years dividends in arrears, right? Because it's cumulative, right? In B, Dingo is off hook on that preferred dividend. Okay, so when we compute earnings available to common shareholders, we subtract preferred dividends based on, you know, whether it's paid or not, how much is paid, or whether it's cumulative or not. We do not subtract common dividend. Okay, because what we are trying to determine is earnings available for common. Whether it's distributed or not makes no difference, right? So the earnings that's already distributed, that's earnings to common, but even if it's not distributed, it still belongs to the common. So common dividends, we do not deduct because some questions, they give you more information, then you need to answer question. So it's just as important is to know what information is relevant and how to use it. It's what information is not relevant and ignore it. Because sometimes people just say, well, if this is given, I must have to use it somewhere and end up using it incorrectly. Okay, so the net income is for each year, it's the same. So I'll just copy it all the way down. It's $5,250,000. Okay, so in the first situation, the preferred dividend is paid. So we need to subtract. So maybe I will just put a subtract. So kind of subtract that preferred dividend from earnings to determine earnings for common. So the earnings for common would be $5,200,000. Okay, and the weighted average share we just did from the previous part. So it's 1,120,000 shares. So earnings per share is 4.64. Yes, rounded up to cents, 4.64. Okay. The second situation, that no dividends is paid and it's non-cumulative, So we do not subtract anything. We do not subtract anything. So all 5,250,000 belongs to the common and divided by the weighted average of shares outstanding. Now it's $6.69. The common dividends is irrelevant. We just ignore it altogether. Okay. Yeah. What did you get? Oh, $4.69. Yes, okay, you're right. $4.69. Thanks for checking. Keep me straight. Next, yes, I really appreciate it because if you didn't remind me, I will get an email after class. How did you get $6.69? Next, the preferred shares are cumulative and 3 years dividends were paid, 2 years for dividends in arrears, 1 year for current. So that's dividends paid is 150, but we only need to subtract 50,000 because it's cumulative. Okay, so we're not missing anything because in the previous 2 years, when company did not declare and pay dividend, when they compute earning per shares, they also subtracted 50,000. Okay, so even they were not paid, they were subtracted for the computation of earning per shares. So we don't need to subtract it again. Okay, so the earnings available to common would be 5.2 million. And divided by 1,120,000 shares. So our earning per share is $4.64. Okay. So then that we are at item 4. So this time no dividends were paid, but preferred shares are cumulative. So we still subtract 1 year, even nothing was paid. Okay. And so when you have cumulative shares, it doesn't really matter whether you declare or paid dividend, how much you paid. Each year you subtract 1 year dividend. That's it. And so it doesn't affect dividends per shares. Okay. Okay. Questions? Good. So that's
Yeah,
move.
I've got a question from the chat.
Oh, yes. Okay. Let's see.
Could we just possibly go back, not to keep everybody else's big, understanding, but could we just go back to the denominator?
Denominator?
Yeah.
First,
So yeah, the first one. So
slide number 3. Okay. Is
Yeah,
this a slide?
yes. So assume that they would have issued shares between November, December, around there.
November,
assume.
September.
Yeah, after September, let's
Yeah.
assume that they would have issued more shares.
They,
And the shares would have been split between common and preferred, with them showing us what the ending balance is.
oh, you're
Or
talking about the
outstanding.
assignment.
Yeah, something similar to the assignment. Yeah.
Yeah.
'cause I was
Okay. You
looking-
just ignore that ending balance. I think you just ignore that ending balance. You don't need it. And I think it's wrong. Just ignore it.
Okay, so then exactly how would we treat the the part where it has the issuance of shares that's supposed to be split between the common, are we only taking what would have been issued to the common to determine the weighted for that period?
Well, yes, we are computing, see this, the last line says weighted average common shares outstanding. So when you calculate the denominator for basic earning per shares, you just consider common shares.
Okay, thank you.
You're welcome. Okay, so let's move on to the diluted earning per shares. Make it a little loud. So assume Dingo's preferred shares are cumulative because we did so many different situations, and so we have to pick one. We pick the basic earning per share being 4.64 as our starting point for this part, right? So if the preferred shares are cumulative, then it's a 4.641. That is our basic earning per share. So that's our starting point. And not only that, it's also convertible. Each preferred shares is convertible to 2 common shares. In addition, Dingo issued 1 million of 8% 10-year annual interest convertible bonds at par on June 30th, 2017. So in the middle of the month, they also have convertible bonds. Each $100,000 bond is convertible into 20 common shares, and the Dingo's tax rate is 25%. So that is relevant to compute after tax interest. Also, Dingo has 100,000 option outstanding throughout the year. The option exercise price was $40, and the average price of Dingo stock during 2017 was $50. So for application of if converted, treasury method, these options are in the money. So calculate diluted earning per share for the year ended December 31st, 2017. Okay, so we follow the steps we summarized at the end of the last class to compute diluted earning per share. If we want to reach this maximally diluted earning per share, we need to do it systematically. First, we calculate the basic earning per share. We already did it. And secondly, we need to compute the incremental earning per share for each potentially dilutive securities. And then we rank them. And then we started incorporating into these potential diluted securities into the calculation of diluted earning per share, one at a time in its order by the rank we just ranked. And if after including one, the diluted earnings per share go down, we keep going. And then when we reach the point after we included one, the potentially diluted security, the diluted earning per share went up, we stop. So that one is anti-dilutive, and everything ranked after that are anti-dilutive. Okay, the one that before that is the maximally diluted earning per share. It's the lowest diluted earning per share you can get. So that's how we do it, right? So that's the step. So then that's it. First, we have 3. So I use this to compute incremental earning per shares. Now you can use these as like to lay out your answer for your assignment if you like, so you can organize the information. So the first one they mentioned here is convertible, preferred shares. Okay. And for the numerator, if they were converted, we already computed several times. So like since they're cumulative, the dividend on this preferred shares are deducted regardless they're paid or not, right? So if they're converted, no need to pay preferred dividend. So we'll add that back. And the denominator, well, how many preferred dividends were there? How many preferred shares were there? Let's calculate. We have $1 million. That is the balance. And we have $1 million, and then there was a par value is how much? 100? Okay, that's $100. So we have 10,000 shares. I don't know. And each one is convertible to 2 common shares. Okay, so we'll multiply by 2. Multiply by 2. And so incremental, the denominator would be 20,000, and incremental earning per share would be $2.50. Okay. And then we have a convertible bonds. Okay, convertible bonds, each $100,000 bond is convertible to 25 shares. Okay, so we also have a 1 million. I will just calculate. Oh, also this is a numerator. So the interest rate on this is 8%. So the interest is $80,000, and adjust for income tax rate. So we'll, oh, sorry. 1 minus 25%. So the, also, these bonds were issued on June 30th. So they were only outstanding for half year. So the 6 out of 12 years. Not 16. And so therefore, the after tax interest, is this a coincidence or what? It's also $50,000. $30,000? Okay. I don't know what note I'm reading. Yes, 30,000. Yes, I'm reading the wrong part of my note. Okay, so 30,000. Do you have a question?
Yes, how did you manage to get the 20,000?
Oh. Okay, so this does, so it's 1 million divided by 100. So it's the kind of a, yeah, that will look better. So that 0 get to push to the next line. So it looks like a divided by 10. So 1 million divided by 100. So that's 10,000. Then that's 10,000 preferred shares. If converted, each preferred shares will be converted into 2 shares. Okay. So therefore, so that's about numerator impact on convertible bond, 30,000 after tax interest. And then the denominator. Denominator, again, each bond is convertible into, what did it say? Each bond is convertible into 25 common shares. So we have 1 million bonds, $1 million divided by the par value of 1,000. So we have 1,000 bonds, and each bond is convertible into 25 common shares. So the number of common shares to be issued is 25,000. Okay. And we have to adjust for the year. Don't forget that. That's weighted average number of shares for that as well. So that's is actually 12,500. So the incremental earning per share for convertible bonds is $2.40. And the next is the options. Okay. The options, they have a 100,000 option outstanding. Now, didn't say anything, so we have to assume that each option will be issued to purchase one share. Okay, so therefore the share, I'm just do all my calculation in this little window. There will be no impact on the numerator. We use treasury stock method, so the proceeds received is not earnings first, and secondly will be spent to purchase as many shares as possible, the two, right? So when the options are converted, the shares issued will be 100,000 shares, assume each option is for one share. And then, so I'll do all the calculation here. So that's the shares issued. We're going to subtract the shares purchased back. How many shares we can purchase back? Okay. The proceeds from issuing shares is $40 for each option. And use that proceeds to purchase $40, not the 40,000. $40 per share, 100,000 shares issued. Use that to purchase at the market price, average market price, that's $50 per share. And so that actually give us, what's the number of shares? 80,000 shares. Okay, so yeah, you can purchase 80,000 shares back. So with that, the net incremental shares issued for this exercise is 20,000 shares. No, is that right? Yeah, 20,000 shares. 100,000 shares issued when the options are exercised. With the proceeds from the exercise, Jingle can purchase 80,000 shares. So net increase is 20,000 shares. And the impact, the incremental earning per share is 0 because numerator is 0. And to rank that, the least incremental share is options. That's ranked number 1. And the incremental shares for the convertible bond is in the middle, number 2. And preferred shares is 2.5. So that's the rank. Okay, so with that, we can start to compute diluted earning per shares. So, so we will start with the basic earning per share, and we use the information we calculated before. One preferred dividends is but when preferred shares are cumulative, the earnings available to common shares is $5,200,000. And the denominator we calculate is 1,120,000 shares. So this will be not incremental shares, it will be diluted earnings per share. Diluted earning per share, at that time it's not diluted earning per share, so I should just use earning per share, stop with all that. So that is 4.64. Okay, so this is, I'm just taking that, do that. Okay, security. Now we add in options. Okay, so we add options and there's no impact on numerator, and there is 20,000 shares increase. And so, I'm not going to show it here because it's confusing to put too many information here. So I'll just leave this. There's this line give you the incremental shares. We already did, right? So I'll just do the diluted earning per share after the first one is added. So the earnings available is 5.2 million, and the number of shares outstanding is 1,140,000 shares. And the earning per share becomes 4.56. So 4.56 is less than 4.64. So this is dilutive, and we keep going. Okay, that will keep going. Then, so if you want, you can these things all together, but we need to read it carefully. This is a diluted earning per share, these adjustments. So this is the first stop. The second stop, we add in the one that ranked number 2, which is diluted bonds. No, convertible bonds, sorry. Or just say bonds. We know if they're not convertible, we won't even bother with it, right? So just say bond. So convertible bond has the impact on numerator, which is 30,000. Increase by 30,000, decrease, increase by 30,000, right? Because that's the dividends, that's the interest will not have to be paid. And increase the denominator by 12,500. Okay, so with that, the earnings available for numerator would be 5,230,000. Yes, and the denominator would be 1,155. Is it 55? 55. No, 52,500. Yes, 1,152,500. And the earning per share becomes 4.54. 2 cents less than before, so that's good. And the last one is the preferred shares. Okay, so preferred shares based on our calculation, that were 50,000 preferred dividends is the numerator, and the 20,000 shares is the denominator. With that added in, the total numerator will be 5,280,000. And the denominator will be 1,172,500. And the earning per share is 4.50. So diluted earning per share will be 4.50. So that's all, every single one of them is dilutive. So diluted earning per share. So the conclusion is we have to state this because sometimes the answering question is like, you have to actually answer the question or just to fit the call. Now all my calculations here, go pick your answer. You got to give it to me. So diluted earning per share is 4.50. So on the income statement, you will have basic earning per share 4.64 and diluted earning per share 4.50. Okay, so I changed it a little bit. Same question here. I will change that just to witness a anti-dilutive situation. That is, everything else is the same. So you don't have to read the whole thing. The only part change is preferred shares can be converted into one common shares if converted instead of two. Okay, so I'm just going to copy what we did and make adjustments accordingly, right? So we did this, none of that, convertible bonds are fine, options are fine, but here it's different. So this will not be 2, so this will be 1, and I will change it, I will show it. So I will change that from 2 to 1. Oh, no, that's not how it's supposed to go. Okay, that's it. And so therefore, number of share of the standing instead of 20,000, it will be 10,000. So we'll change that into 10,000. So I'll highlight this part. So this part is okay, that part changed and that part changed. I want to change the whole thing, just stop. So that changed. So with that change, this one will change as well. It will be $5 per share. Right, so that will change. Still ranked number 3, but it's different. Okay. Next, I will change that this calculation diluted per share. So the first bit is that this is the part we need to change here, right? So this is the part we need to change here. So I'm just going to change this part. So with that increase, this will be 1 instead of 2. So it's 10,000, and this will be 1,165,000. Now, no change in numerator, only change in denominator. And then the earning per share here will become, I don't trust it, but I think it's 5.56. Just let me confirm that. I think that's what it is. Yes. No, let me see. 5, 2. Yeah. Wait a second. Five, 5280 divided by 1165.1. Something is, oh, 1 point. This is 2. Okay, let's try again. 5280 divided by 1162.5. It's still 5.54. Is it still 5.4? Oh, okay, still 5 point. Okay, so it's not anti-dilutive. Is it? It's still not anti-dilutive, but it's no longer decreasing. Is it have so little impact that it never changed? What happened before? Oh, they didn't change before. This one did not change. Okay, so I guess it's not. So 1.4512. This one is this is a 4.538. So there is a slight change, but it's so so small. If you round it up, it doesn't show. So diluted earning per share should be this one. However, when you round it up to the cents, it doesn't make any difference. Okay, so this in a way, it is in theory, in principle, this one is anti-dilutive. Okay, so that's just for the sake of making the point. So that should be the basic earning per share. Now, this question, let me just go back to say a little bit. This question, right, is kind of just purely for exercise. Like you don't need to do this. You can see it because basic earning per share is 4.64. And the incremental shares for this one is 5. So you don't need to do this to know that it's anti-dilutive. Okay, this is just confirmation. But it is possible the incremental share is less than basic earning per share, but it's still anti-dilutive. Because in this process, when you included more dilutive potential shares, your benchmark move down, right? As you include options and other more dilutive one, what you compare to will go down. And so that is the benchmark. You will go down. It will have some kind of like a curve like this. And so when it moves down, whether it's dilutive or not, will not be whether it's more or less than basic earning per shares, but it's already dilutive earning per share. So that's why this process is foolproof. Okay, so you know when the situation is not so obvious, you will be sure you will get the right solution. Okay, any questions? This is pretty exhaustive, comprehensive. We cover all the issues we need to know about this in this chapter. Okay, so we have a little time left, so we will start on this review. Okay. Okay. So this chapter is about income tax. And before we go too far, let's talk about the topics in the chapter. So let's just review this asset liability approach and contrast that with the revenue expense approach. And you know, we know when at the year end, when we prepare adjusting entry, whatever you adjust for income statement account will affect balance sheet, right? So they are connected. And a lot of times it's no problem. You can measure, when you measure one properly, make adjustment, the other one is properly measured. But sometimes that situation is not true. Okay, one of the example you may be able to see it very clearly. Did you guys talk about the LIFO, FIFO inventory? Yeah, you talk about LIFO, FIFO inventory, and LIFO, FIFO give you different cost of goods sold and ending inventory if there's inflation or deflation, right? And so because the cost of your inventory changes, so at the end of a accounting period, if you use LIFO, your cost of goods sold will have more recent cost, will be more accurate. But if you do that, your inventory will carry very old costs, okay? If you use FIFO, first in, first out, then your inventory will be more up to date because of the newest one left on the balance sheet, right? But your cost of goods sold will be more out of date because it will have older costs in that, right? So that's another example here. You can't make both happy. You can't have the perfect income statement that reflect more relevant information and the balance sheet. Because if you make one more recent, the other one will be more out of date. Does that make sense? So that's a dilemma. Now, what do we do? This is a kind of like a philosophical situation, which financial statement is more important? And the people change mind. Know this, before 20th century, like before like the Great Depression and things like that, the stock market crash and that, financial reporting is different. So for the when double entry accounting was invented 550 years ago, and it was invented by a priest, and their goal is a Catholic priest, and the Catholic Church was the richest institution then. And so the purpose is just keep track of their treasures, their wealth. And so there's only balance sheet. The income statement was not important. All they know is like, oh, the gold and this and that, you know, like where they are, and make sure they're be taken care of, like what do you call it? The stewardship was the thing. But with the birth of the corporation, the separation of the ownership and the management, okay, the management become the insiders, but they don't own the company. The owners, the shareholders, they are the owners, but they are the outsiders. So they need information to know, like to assess their investment, assess performance of the management, so on and so forth. So they need more timely information. They need you need to know how you performed this, like recently, so that income statement becomes one new statement and becomes very important. So for like for about half century, maybe even more, income statement was very important. So when you come to the situation, you can't measure both correctly. The focus will be measuring revenue earned and using the matching principle to measure to report all the expenses incurred to earn it, so net income. As a result of that, whatever adjustment you need to make, you know, balance sheet will be affected. Whether balance sheet is good or not, that's a lesser concern. However, that has changed. Now, it's an asset liability approach. So you need to measure all your assets and liability as accurately as you can. Assets are the probable future benefit. So as a result of that, there will be like a fair value. Fair value was a new thing, right? Because like if you do fair value, you're more concerned about whether the items on the financial statement reflect its current value, and any change in value becomes your revenues and expense, gains and loss. And the same thing is liability. So that's the current approach. So this is an example of that. So say ABC had a net income, net earnings, like just make it simple, of $100,000 from installment sales during 2020. And they are recognized when earned for financial reporting purpose, right? We know accrue-based accounting. However, they are taxable when cash payments are received. And we're saying that like the cash payments are received, will be received during from 2022 to 2028. That's what installment sales are. You pay gradually after the purchase, right? So ABC is subject to 30% tax rate for all its earnings. And so that's true in 2020. But in 2021, the tax rate changed to 20%. Okay, so what happens here? So in year 2000, you have this net earnings, like basically it's a before tax net earnings, revenue minus expense. Let's just say that, right? Well, 100,000, there will be tax of 30%, 30,000 tax, right? However, because you do not have to pay for it yet, because for tax purpose, you haven't earned it yet. You do not have to pay it. You pay when you get paid, okay? So this tax will be called a deferred tax. So for financial reporting purpose, we have, let's use T account to illustrate this, okay? So let's put it here. So we call it deferred tax liability. So that's how you deal with, because you need to debit income tax expense. So deferred or future tax liability. Okay, so you will have 30,000. This is 2020. Okay, so therefore you can report your net income statement. You will have income of 100,000, subtract 30,000 income tax. So your net after tax income will be 70,000. You need to report 100,000 according to the GAAP IFRS, right? So if you do not deduct tax, that's not right, right? Because there is tax on that. So you have to recognize the tax, even though you don't need to pay for years to come. Okay, so how do you get around it? Create a deferred tax. Debit tax expense, 30,000, credit deferred tax. So you don't have to pay yet. Okay, so that's 2020. Now 2021 comes. Okay, nothing happened. Based on this story, nothing happened. They didn't say anything about more sales, and there's no collection, but this collection is starting 2022, right? Nothing happened, no transaction. However, the tax rate changed. And the tax rate is, now it's 20%, and from now on and go forward, right? So when 20 and 22 comes, when you get a payment, you have to pay tax. Now you only need to pay 20%. So what happened is you do not owe government 30,000 because the tax rate changed. You owe government 20,000, right? Now, asset liability approach says you got to make adjustment because this 30,000 is not your liability amount. Okay, so what do you make adjustment? You do it that you will credit this. So this is in 2021, even though nothing happened, no transaction, right? Well, something did happen because the government announced they're going to reduce tax rate. And then so this is 2020 balance. So the balance will be adjusted to 20,000. Okay, so this is very good for the balance sheets, right? That's a reasonable thing to do when all the information indicates that the tax we will have to pay when the installment payments are received is 30,000. We recognize 30,000 as liability. Now the government reduced the tax rate. So when we get paid, we will be using 20% to determine the tax. So when all these payments are received, we will pay 20,000 income tax. That's our liability. So I make an adjustment. Okay, but look at the income statement. You have to agree it's a bit weird, right? So the first year we have revenue, like, you know, like before tax income 100,000, tax 30,000, and net after tax income 70,000. Nothing happened in 2021. Now I have to record 10,000 after tax income because you will debit deferred tax liability and you credit tax benefit, right? But that's kind of weird. You didn't do anything to earn that in 2021. However, that's what asset liability approach dictates. That's what you should do. Now, what would happen if you use revenue expense approach? Well, you do the same thing for 2020 because that you don't know what you don't know. You can't do it, you know? And 2021, you will do nothing, right? Because you didn't earn any revenue. You didn't, you know, so nothing to match that. And so you'll carry your liability at a 30,000. And think what happened after that. Each time when you collect an amount, you will pay tax at the 20%. So by the end of 2028, you will have to collect the entire 100,000, pay all the tax on it, which is 20,000. And then you will leave 10,000 on your balance sheet. No way to getting it off, right? No way to getting it off. Well, without violating like a matching principle, right? And that's the situation actually. One of the reasons justify for this switch income tax is the thing, because the tax rate has come down over the years. And it's like a part of the tax planning, which you're talking about tax, is to minimize tax to pay within the define of the laws. That's fine. That's like that's okay. That's how government use tax policies to influence the corporate behavior, right? So you are supposed to respond to with the tax regulations to minimize your tax. That's fine. So lots of companies would have deferred tax liability. And when tax rate decreases, and so the deferred tax liability would decrease. But when you use revenue expense approach, you don't do that. You just leave it. So over the years, lots of companies will carry quite a bit of deferred tax liability, which they never have to pay. Well, that's not a very good balance sheet, isn't it? Right. So anyways, I'm going to stop here. So that's a quick review of revenue expense approach. Okay. Okay, see you guys on Thursday.